This video is for you if you're looking for some kind of unique crypto projects, specifically where the profit for you is not tied into the price of the coin. We've all seen the market for the last few months be very choppy and specifically seem like it's going down. And depending on how the next few weeks play out, we could very well enter a bear market. And so a lot of us are looking for opportunities where you're not just investing in a coin because all the coins are pretty much going down right now. And that's what this video is going to be about, is all the different projects that I'm in where I'm not reliant on the coin price to make any money. Now, I do want to make sure that I say I am not endorsing all of these projects. And in fact, some of these projects seem very, very similar to Ponzi schemes, but I have put a little bit of money in them because it seems like there's some potential. So please don't ever come back and say, you endorsed this project and told me to buy. I'm not telling you to buy any of these projects. I'm just showing you the ones that I'm in that I think there could be some money made on, despite crypto prices going down. Now, on that note, I'm gonna tie the next one that I'm gonna talk about as close as I can to that disclaimer I just gave, because I think this is probably the most Ponzi-ish thing that I'm involved in. And it's called the Hyperverse or the Hyperfund. I didn't put a ton in this because it seems kind of strange. And I'll tell you in the end why I did put in a little bit of money. Essentially what you do is you buy these packages. Okay, so you create this account on this Hyperverse and you buy these packages that are purchased with crypto. And you can see on the screen here, there's different packages ranging from 3,000 to 1,500 to 900, all the way down to 50. And HU is what it runs in, which is essentially a stable coin. So you can think of these as $50, $900, etc. Now, the way these packages work is they pay you back 3 times the amount you paid them over a period of 600 days. So they pay you about every day, and currently they say they'll pay you back 3 times the amount you paid them over a period of 600 days. Now, 3x doesn't sound that great over 600 days in the crypto world, but this is kind of the 2 reasons that I'm involved in this. The first one is that you can take that money that they give you and you can buy more packages. So they pay you every single day and you can continue to put that in. And if any of us know anything about APY and how that all works, if we're reinvesting the money every single day, the 3x can become a 10 or 15x very easily by doing that. So what you can do is, you can see right here in my account, I'm buying more memberships with the money that's coming in from my old memberships, and I'm not putting any more money into this. So the reason I'm doing this is I think I can generate a lot more than just 3x in my returns by continuing to buy more packages with the old money, and I can turn that 3x into 10 or 15x. So that's reason one. Now, the second reason that I was willing to put in a little bit of money into this is the 2 founders. Their names are known, and they're billionaire crypto investors that are fairly well known in the space. And while I still don't love the model and stuff like that, I'm willing to put in a little bit because they seem to be staking their reputation on whatever it is that they're doing here. All right, so as I mentioned, I am not recommending this, and it even has a it has a referral program and stuff built into it as well, which obviously becomes more and more suspect when you see that the model is built around maybe more people coming in to keep it going. Anyway, this is one of those projects that I have thrown a little bit of money in to see what happens with it. Number 2 is a much more legit method that I feel much more comfortable talking about, and that is the Anchor protocol, which is essentially a 20% guaranteed interest rate that you can get inside of crypto. And it uses a stable coin, so you can see right here UST, which is a stable coin, and basically 1-to-1 ratio to the US dollar. And then when you take this UST, you buy some, you bring it into the Anchor protocol, and then they pay you 20% on it yearly. And I was in it for about a year and it did very, very well. Now, I just sold mine because I wanted to use the money for something else, but I still heavily recommend it. It worked exactly as it purported to work, and I was making 20% interest for about a year on about $10,000, and no issues at all with that. Now, the way that they say it works is they take the money that you give them and they're out there lending it to short-term traders and things like that, and charging a high interest rate for those short-term loans that they're giving, and then that's how you're making the money. Now, looking deeper in it, it still seems a little bit funny because they actually pay people to take out loans as well, which is a little strange, and I think that's hopefully just something they're using to market and grow. But anyway, I'm not sure how long that can last if that's their long-term model, paying people to borrow and paying people to lend. So I would classify this as safe for crypto, but it's definitely not a bank. Now, your bank is giving you 0.5% interest, and so for me, that, what is it, 20, 40x interest is worth the extra bit of risk. but that's obviously up to you. There is a video down below if you want to learn more and get started using the Anchor protocol. Now we're going to do one more safe one before we get back into the really risky ones. Maybe not quite as risky as Hyperfund, but still more risky plays with higher rewards as well. This one I'm going to talk about is Blockfi. Many of you have heard of Blockfi. Essentially, all you have to do is hold USDC and you'll get a 9% interest rate yearly for that, which is a stable coin. Or you can just hold your Bitcoin or any of these other coins you can see right here inside of a Blockfi account, and you can see you'll get these kind of interest rates from holding it there. But what I use it for typically is to hold USDC, and I'll get a 8 to 9% interest rate on that, which is a guaranteed interest rate and fairly safe because this is a company that's registered and well known and has a reputation and things like that. But once again, we've lowered our earnings by quite a bit here as we continued working our way down into the safer places here. So let's work our way back out of the safer places here, and we'll get into some more of the risky stuff where we have much higher gains. And so I want to talk about one that's probably my favorite of all of them. Of all the opportunities I'm in right now, this is probably my favorite right now, just based on how it's working for me. So once again, I'm not endorsing it. I'm not saying you should be doing it, but just in terms of results for me. And that is Strongblock. And what Strongblock is it's called nodes as a service. Essentially, you pay this company, Strongblock, and they go out and create Ethereum nodes for you, and then you get paid for those nodes. Now, there's a little more into it than that, and it's important to note that the model does rely on new users coming in, I believe, for it to continue working, which is not a great sign, something we don't love when we're making investments. But what you do is you buy a node for 10 Strong. And the price of Strong right now is about $600. You can see this is kind of the Strong chart over the last year. It's bounced around quite a bit, but right now it's sitting just below 650. And what you do is, so for about $6,000, you buy these Strong nodes, and then they pay you out 0.1 Strong every day. So that means at the current price of Strong, each of these nodes will be paying you about $60 a day. So you pay 6,000, and assuming the price of Strong stays the same, so right where it's important to note all this is happening in the price of Strong. You need the price of Strong to be uniform here, but you'd be able to pay off that node you bought over a period of about 3 months or 90 days, and then after that, it continues to pay 0.1 Strong each day, and that all becomes profit. Now, the price of Strong, right, is reliant on demand, which means we need a lot of people coming in and buying this Strong for it to continue to maintain this price that's been pretty good, around $600 right now. So if no one starts using Strong anymore and people are just selling Strong, right, they're getting their 0.1 Strong every day and selling it, and there's no new buyers coming into this Strong ecosystem, we'll see a collapse of the Strong price. Now, I bought this a few months ago, and I'm at break-even point now, and so for me, it's awesome. It's just pumping out that money. That may not be the case anymore, and that's a risk you would take if you got into Strong. But again, there is a link down below showing you how to get started with all this. Just note you do need about $6,000 to buy that first Strong node. Now, the next one is just one of those crazy fun plays. I definitely don't think it's a scam or anything like that, and in fact, I think it's a pretty cool project idea. That being said, it's definitely one of the riskier ones that I'm in, but it's nice that it's not reliant on the price of a Bitcoin, basically. So what it is, it's called Klima DAO, and it's staking, if you've heard of staking. Now what they do is they give you a 30,000% APY, yes, you heard that right, for staking Klima. Now there's a lot of coins out there. This is kind of the big hype right now. I like the proposition behind Klima, and I'll explain how this all works. So what the project does is it buys carbon credits. So carbon credits are things that companies can buy that allow them to essentially pollute a little bit. The project here buys carbon credits up as we put money into it. It takes those carbon credits and it attaches coins to it, if I'm understanding this correctly. And when it attaches coins to it, you can buy those coins and then you can stake it. Staking it says, hey, I'm not gonna sell this coin or do anything with this coin. And then they pay you in Klima to stake it. And what their idea is they're kind of taking carbon credits out of the market. Essentially, they're making it more costly for companies to pollute and forcing companies to perhaps get more innovative because now their traditional ways are not working as well and they're more expensive for the company. So the idea is they're essentially creating a supply-demand issue with carbon credits. Now, that being said, the APY is great. I bought about 10 Klima and staked it not too long ago. And now I'm up to 25 staked Klima. So I've more than 2.5x'd my amount of Klima. Now the only issue with this is let's take a look at the Klima chart right here. And you can see here, that is one ugly chart. And that's typically what happens when you have an APY like the one that these guys are promising. They're pumping out so much that you're essentially getting inflation and the value of Klima goes way, way, way down. And in the end, I have not made profit off this. but the project is still young. It's only been around for just a few months, and I think there's a lot of potential for them in the long run. And there's some big names that support this and are involved in this as well. And which is why I'm getting involved now, hopefully stacking up a bunch of this coin while it's down here. And then as the price starts to potentially go up, I already have built up a lot of Klima at the bottom there. Funny little side note right here, the project that we were actually about to talk about right at this moment turned out to just barely be a rug pull, and they totally removed all liquidity and stole a bunch of money from investors. So we're obviously not going to talk about it, but hopefully that highlights the risk of most of these projects that we're getting into. These aren't low risk, easy projects. Each one of these comes with quite a bit of risk. And so we're going to skip the next one that we were going to talk about because the risk turned out to be very real. Now the next one is one of my favorites as well. Hopefully I haven't said that on all of these. For two specific reasons. One, it's a real world project with real world use case, and it's very quickly growing. And two, it's been very, very passive for me with one simple investment that's already paid itself off, and now it's just making money. And what you can see right here is Helium. And what Helium is essentially they're trying to create a small competitor to Verizon or AT&T or any of these big cellular networks. Now they're not trying to do it with cell service or anything, but they're trying to do it with much smaller bits of data. So if you think of things like, for example, my car can turn on with Wi-Fi. I can, from my phone, turn on my car. Now that car has to be connected wherever it's at. It doesn't need a ton of data, but it does need to be connected. And there's, a lot of cars are like this, a lot of smart appliances, a lot of different devices now are starting to be smart and they're connected, but you don't necessarily want to pay Verizon or AT&T or have them connect to a cell phone line. And so what Helium does is it gives you a little box like we're going to show you on the screen right here. You stick the box in your house, and then you become a little piece of this massive network. And you can see right here, the network is huge. Each one of these little dots represents a box. And you can see in some cities, they've completely saturated the entire city. And then this coverage, right, will be sold similar to Verizon. So you'll see all these new devices that need some small amount of internet access connect to these devices. And every time your device is used, so in my case, my little box over sitting there in my window, every time that gets used, I get paid. Now, right now, miners are really hard to come by. I have one miner sitting in my window. It cost me about $500, and it's paid off now to the tune of about $1,700, and it continues to generate 10 to 15, 20 bucks every single day. So I'm gonna leave a link down below. The only way I know of currently to access this is not, in my opinion, an ideal way, but it's the way that I had to do it, simply because there was nothing left in the supply chain for us, is kind of an MLM thing where you essentially give this company, they rent you one of their devices they've already purchased, and you pay a portion of your earnings to them every single month. Again, not stoked about it. If there's a better option out there, go ahead and take that one. But that's the way I signed up because I didn't have any other choices and couldn't find access to this box in any other way. And the very last one is one I've been doing for the very, very longest, and it's been pretty interesting to see how it works. Again, we're going into staking, but we're staking a much more consistent coin. And the coin is called Cake, and it's the token of PancakeSwap, which is the main exchange for the native Binance token. So all you do is you go to a site called AutoFarm, and I'm not going to show you how to do this. Again, there's YouTube tutorials out there for that. But essentially all you have to do is buy their token, okay? You need to buy their token, and then you need to go to this site, you need to connect a wallet, and then you deposit your token into this site. And the current APY is about 70%. Now that's a lot less than some of the APYs that we've been seeing, but it's also a lot less risky. You can see here the price of PancakeSwap is much more stable. You can see right here, this is about a year. It's gone up over the last year, and stable for crypto, it stayed somewhat stable. And in fact, I'm gonna throw up two charts here, a year chart for BNB and a year chart for Cake, and you'll see that it kind of follows the price of BNB since that's what the exchange focuses on swapping. So what that means is it seems to follow the price of BNB, which has been going up and is a fairly stable coin, but you can also still get this 60% APY, which is what I've been able to do over the last year. And you're able to do it in a slightly safer way than perhaps these 30,000 or 80,000 APY projects. And that's the end of the projects that I'm in right now. Hopefully there was at least one you haven't heard of. There's one that maybe you want to get involved in. I'm going to give a disclaimer again that I'm not endorsing a single one of these projects. Plenty of these projects are high risk. Some of them are extremely high risk, but these are the ones that I'm in. You asked, this is the video that delivered. Thanks so much for watching, guys.